Good day, ladies and gentlemen. Welcome to a Standard Bank webinar hosted by SBFC, Standard Bank Financial Consultancy. My name is Ketwe Gunene and I'm the coordinator. Today we're talking about investor temperament in times of uncertainty, and we've got four very qualified panelists to talk about this topic. But before I tell you about them and hand over to them, I just want to do some housekeeping. Two aspects that I want to talk about. The first one is sound. Please make sure your volume is as high as possible so you can hear everything. And on your taskbar at the bottom right-hand side, if you find your volume knob, you can put your volume up there. Secondly, I'd like to check if the sound on your side is good, so that if it isn't, I can then stop and pause to find out solutions. So what you need to do on your panel, on the right-hand side of your screen, there's a panel there. There's a small high five. It looks like a small hand. If you click that on your screen, I'll be able to see that you can hear me, and then we can carry on. The more hands I have, the more we can. Yes, there you go. Thank you so much, Sukona. Thank you, Ursula. Okay, hands are coming up. Thank you, Tendai. Thank you, Sikelo. All right, majority of the hands are coming up so you can hear me. That's great. Second aspect I want to talk about is questions. If you've got any questions during the presentation, on that same panel, there's a questions tab. You can click that and type your question in. What we will do is address the questions at the end of the presentation so that we don't disturb the panelists. Okay, so your question will be attended to at the end. All right, so let me tell you about the speakers you'll be hearing. There'll be four different voices during the presentation. First off is our resident DJ, Mr. Errol Meyer, who's a certified financial planner and an admitted advocate of the High Court SA. He holds qualifications in finance, law, teaching, and taxation, and he's our advisory propositions legal specialist here at Standard Bank. So he's going to head us off with this presentation. Then we've got Mr. Malcolm Holmes, who's the head of portfolio management at Standard Multi-Manager. Been in the industry for 23 years, first with SCMB Asset Management and then Standard Multi-Manager since 2002. And he's a designated portfolio manager on the Standard Bank Gold Standard Funds. He's going to be our second speaker. After him, we're going to have Mr. Winfred Haynes. He's the head of our retail investment funds with 21 years of industry experience. Mr. Winfred joined Standard Bank Wealth in August 2015 to head up the bank's retail investment funds initiative, the first set of funds the bank has brought to the market, which is a set of goals-based funds that is housed on the license of Standard Management Company. And last but definitely not least, we've got Johan van der Merwe, who has got, interestingly, a qualification in neuro-linguistic programming. So he's an LLP practitioner. He's got FILPA, CFP, MD Mechanical Engineering. So he joined financial services industry as an IFA in 91, then joined SPFC as a planner in 92 to 98, and then SPFC management in various roles from 98 to 2006. And currently, since 2006, he holds a position of risk and wealth manager. So as you can hear, it's a mouthful for each of these panelists. So it's going to be an interesting talk. That's it from my side. I've done my part. Now I'm going to hand over to Mr. Errol Meyer, who will start us off. Good day, gents. Good luck.
There we go. Thank you, Katiwe. Well, good day all attendees and welcome to our webinar, and a special welcome to our panelists joining me today. Now, there's no doubt that our local economy is sluggish and political uncertainty stays an influential factor. It is noteworthy and sometimes understandable that many investors change their investment portfolios during these times of uncertainty. You will hear during this presentation that investment funds are experiencing large outflows of money. The critical issue that we want to address today is to understand, why is this happening? Is it because some investors have lost confidence in our local markets and moving funds somewhere else, such as offshore? Or is it because some investors see market moving sideways and conclude that their investments are not performing as expected and look for other investment avenues? This is not what I've been told and sold. One hears all the time how easy it must be for the unscrupulous advisor or misleading advertising to ride the emotion and sell you something else. And so a destructive cycle is set in motion. Now, who's to blame? The truth is that we ourselves will have to take some of the blame. Not educating ourselves about fundamental investment principles and letting our emotions get the better of us plays a significant role in our decision making. Why am I telling you this? Well, in the media, We are bombarded with emotional information to promote the supply of services and products, and then we internalize this as a rational decision. How many more ab exercise machines must I hear and see that promise you that sporty, muscled six-pack, and guess what? It needs no effort. And just look at the physique of the person explaining the benefits. But deep down, we know this is not entirely true. Yet we buy it. What an easy sell. Interesting that there is always a latest model, and there's no shortage of new fancy ab machines. And they sell. That is right. We are often dummies when buying goods, since the way it is sold is devised to get our emotional decision-making process going. The question really is amazingly simple. What are you afraid of? And why are you so greedy? Warren Buffett also said, be fearful when others are greedy and greedy when others are fearful. But today, we want to make sense of what Warren Buffett meant by the most important quality for an investor is temperament and not intellect. Temperament means character, nature, or personality. Also, the quote surely does not say no intellect. But then, how will I know whether I'm doing the right thing if I'm not a financial investment guru? I must trust someone making use of my emotional IQ to make the right choices. But how do I know that such a person has my best interest at heart? So then, we need a certain amount of intellect. Now, education plays a key role in making an informed decision. And this is what we want to achieve today. Today, you will hear from our experts that we are experiencing in investment markets, how emotions often override logic. What is the logic? And why financial planning can add value to the life of an investor. So, our agenda for today is we're going to start with Malcolm with the market overview. We're going to look at long-term investing volatile markets. We're going to talk about diversified portfolios, and then we're going to have a panel discussion, some questions that I have put together to put to the panel, and then I'll end off with the conclusion. So, before we get started, maybe a short introductory statement. And can I ask my colleagues, what do they think that Warren Buffett meant when he said the most important quality for investors is temperament, not intellect? So let me start then with Malcolm.
Well, thanks, Errol, and welcome everyone. Well, it is a beautiful word, isn't it? Temperament. It's a behavioral quality. And I think he was just pointing out that it's more important than how clever you are. Temperament can obviously be good or bad, and on a continuum of cool, calm, consistent, and collected to bad-tempered, emotional, and erratic under pressure, he was probably referring to the former. You'll remember Wayne Ferreira or John McEnroe. They did produce good results at times, but listeners would certainly remember that they got very cross and emotional and erratic, and this probably impacted their judgment and ability in the heat of the moment and stopped them from being better players over the longer term. Now, Roger Federer, on the other hand, he has great temperament as a player. He always seems to look so calm and measured, and this aids his ability, and he has consistently produced excellent results over the years. So too in investments. Temperament is particularly important when tough decisions need to be made or markets fall sharply. The typical behavioral bias is to panic and sell out only to become a forced buyer later when markets ultimately recover. Younger investment professionals need to learn good temperament early in their careers, and we use the example of an aeroplane pilot. No matter how difficult flying conditions are, the pilot is always so calm, collected, and confident. How many times have you heard, ladies and gentlemen, we have turned on the fasten seatbelt sign as we are experiencing some turbulence. No hot drinks will be served, but please sit back and relax and enjoy your flight with us today, and we'll keep you updated. It's reassuring for passengers, but also allows the pilot to make effective decisions. I also often joke with the younger PMs that they should only panic when our performance relative to competitors gets into fifth quartile. And it's not that intellect is not important in the decision-making process. The starting point in investments is that all professionals have that. But for Buffett, speaking in the context of a professional asset management decision-making process, he feels that the behavioral quality of good temperament is superior to intellect, especially in difficult times. So retail investors can learn a lot from Buffett's statement, and that is to seek out professional advice, invest for the long term, review your investments from time to time, but don't be swayed by the volatility of the market in the short term. Rather just remain calm. Winfred?
Thank you, Malcolm, and good afternoon, everyone. Yeah, I'm going to sort of just focus on maybe the context of Buffett's quote. And for me, I think it boils down to avoiding a herd mentality. It really, we know that from the research, average investors, they often underperform markets over the long term. And it's an age-old saying, they buy when markets are high, and they sell when markets are low. So I think from my perspective, what Warren Buffett was trying to say is that investors need a temperament that neither derives great pleasure or is indifferent from being with the crowd or against the crowd. In other words, don't just follow the herd. In other words, investors must keep their eye on the prize, which is a long-term return. And they must, as Malcolm said, they must not panic when short-term noise presents a distraction. Thank you.
No, thanks, Winfred. Johan?
Good afternoon, everyone. Thank you very much. I think, what's the most important thing from a financial planning point of view is that if we've got clearly defined goals, we know where we're going to, we know what's happening in terms of, it will take a lot of the emotional side out of this in terms of our investments. We don't go into knee-jerk reactions and just switching funds and try to achieve goals. But if we've got clearly defined goals, we are there for our clients and we have got regular communication with them and help them achieving their goals. I think that temperament and emotion will go out of this one.
So you're saying if we have a good process, that could help a lot to curb these emotional behaviors. Okay, well, thanks, Johan, for that. Well, let us find out, and I think a good starting point is, let us start with the logic, the intellect. And then I'm going to hand you now over to Malcolm, and then it's going to be followed by Winfred, and then I'll start the panel discussion.
Thanks, Errol. I'm just going to flip forward to the market overview. It's a very high-level overview of global and local markets. I think many listening would remember and know that the world's been adjusting, to a post-GFC environment, global financial crisis. Since the global financial crisis, you've seen a lot of effort being put into sort of saving sort of the corporate world, and things like too big to fail and quantitative easing, kind of new sort of monetary tools to buoy up the economy, keeping interest rates low for longer. In May 2013, we had the taper tantrum, and then more recently, interest rates have been normalizing. And now it kind of looks like the US Fed wants to go the other way and start cutting interest rates, which ultimately would, be good for emerging market bonds and currencies like South Africa. And during this period of time, since the end of the global financial crisis, global equities are actually up a staggering 400% cumulatively. In spite of everything that's happened, in spite of all of this, that's 14.4% per annum since March 2009. We've also had the 2016 election of Donald Trump, a fairly controversial character, but certainly put America first. Looking at protectionism, he's cut taxes, which has obviously been good for equity. And more recently, there have been lots of talk about trade wars around the world, which is never good for markets and economies. But in spite of this, since his election, the S&P in dollars is up 13.1% per annum. So it's been a fairly good ride from that perspective. Now, bringing it back home, South Africa, unfortunately, has had pretty poor economic growth and rand weakness. Growth has been kind of averaging around 1% per annum, instead of the 3% that we really need to get this economy going. And the rand has weakened a little over 6% per annum over the last 5 years as a result of policy uncertainty, low business and retail confidence, political turmoil, and other things. So that has unfortunately not been great for South African growth assets like equity and property, and they've disappointed relative to their histories and their own expectations. And it's because of low economic growth. We've had sort of questionable accounting. Many corporates in South Africa have struggled. We worry about investment grade status and some of the foreign outflows that have happened and could result. During this 5-year period of time, SA equities are actually up 6.1% and SA property up 5.8% per annum over that period. So it's not that they're negative, it's just that they've been a little bit disappointing. And maybe just to hand over to Winfried to discuss now the benefits of long-term investing.
Thank you, Malcolm. Yeah, I think as per Errol's introduction, we are facing uncertain times, and I thought it would be a really good idea to visually show our listeners what it actually means and why is it so important to remain invested in the markets. So the chart that is now appearing on your screen, the green line, which is the top line, is effectively the South African All Share Index, and what we've plotted for you there is a 100 Rand that was invested in the index prior to the start of the 2008 global financial crisis, and clearly you can see where that 100 Rand ended you up as of current times. But then it's very interesting to put two scenarios against that, and the first scenario is the red line, which is the bottom line, which is effectively a scenario whereby an investor decided that at the end of the financial crisis, I've had enough, I can't stand this, and I'm now switching all my money into cash. And that's clearly where you can see where that strategy from an investment perspective ends up, and you can see how you have underperformed the 100 Rand that remained invested in the index over this time. And the third interesting scenario is where an investor decided, I'm going to actually just take some time out, and after being in cash for a year, I think I'm now ready to go back into the markets after being out of the markets for a 1-year period. And that's the dark blue or potentially a black line that as may appear on your screen, and you can see where that position ends the investor after a year. So I think if we move on to the next slide, let's get straight to the point. I mean, what the picture is showing us here is that one has to remain disciplined and remain invested. It may be that many investors may have seemingly made money by timing the market correctly. In other words, they may have predicted market movements and sell or buy shares accordingly. But we believe that it's likely that many of these success stories are due more to luck than to skill. For the average investor, it is not only difficult to foresee market upswings and downswings, it is also challenging to make decisions that aren't marked by emotion. So the golden rule is always, it's about the time in the market, not trying to time the market. And I know you hear this quite often, but you've now seen examples, and here we're visually trying to show you there is a return that's produced by the market, and then there's investor behavior that leads to this, as we've labeled this behavior gap. So it's maybe easier theoretically to talk about this, and how does one then actually respond in times of market volatility? So as much as this may sound counterintuitive, during times of market volatility, your right course of action might actually be to take no action. While this is hard to do, because volatility in markets can leave one feeling very, very vulnerable and concerned, and therefore compels you to want to react. However, if you focus on the long-term trends of the markets rather than the short-term movements, should you give an investor the confidence, I mean, behavior like that gives an investor the confidence to ride what we call these waves of volatility. When examining historic equity market data, we see a trend of rebounds following equity market pullbacks. That means that investors who jump ship after a big wave may have broken the cardinal rule of, as I've said before, investing by selling at the low. Consider this practically. If you own a home and someone told you its value went down this year, would you actually panic and sell? So most likely you will not. You bought your house because you knew you'd be there for a while. So its day-to-day price isn't that important. Chances are your home's value will rise over time. And that's ultimately what you are focusing on. I'm going to hand over back to Malcolm to perhaps just talk about how diversified solutions or portfolios are constructed.
Thanks, and that's a great point about house prices over time generally go up, equities over time generally go up, and this is really the point of our next slide, where we're introducing the topic of diversification now, sort of having a blend of some assets that are more safe and steady, like cash and bonds. Over time, you'll see cash can probably beat inflation by 1% per annum, and bonds a little bit more, by maybe 1.8%. So it's having a combination of those types of defensive assets with some of the growth assets that can really give you that boost over the long term. And perhaps if there's nothing else that you remember from this particular presentation, it's that over time, okay, equities can produce inflation plus 7 or 7.2% per annum. Okay, so it's the highest returning asset class. Property can do about 7%. This is what history has shown us, and this is what one can expect these asset classes to deliver over time. Now, the problem with them is that in the very short term, okay, they can be volatile and they can fall, and it can be a very uncomfortable ride for you. But if you're not really worrying about the short term and you're focusing on your longer term goals, this is really what you should expect from these asset classes. So you could blend your asset classes, create a portfolio for yourself, so mathematically, really, just by investing in proportionately into these different types of assets to sort of achieve your required rate of return over time. And really, it's about diversification, because often these asset classes are uncorrelated. If equities are falling, maybe bonds are rising and cash is kind of doing what it does. So yeah, I think that's important. Maybe just moving to the next slide, to follow on from what Winfred introduced. What I've added in here is a combination of a low equity composite, a portfolio that has low equity characteristics, a bit more of the defensive assets, and then I've added in the high equity composite, a portfolio that is not 100% equity, which is obviously what the green line is, but is a diversified portfolio with high equity characteristics. And clearly, had you not done anything from the beginning, even prior to the global financial crisis, the blue line on the screen, you actually would have ended up in perhaps the best position, even beating equity over that time period. But it's really more about sort of not trying to win by selling everything, going into cash, and then buying everything again. It's really just investing for the long term is about picking a mix of assets that ultimately suits your profile, whether it's a low equity combination or a high equity combination. Being diversified in that way allows you to smooth the ride out a little bit, and over the long term, you tend to achieve your objectives. So back to you, Errol.
Okay, well, great. Well, thank you, gentlemen, Malcolm and Winfred. So let's get the panel discussion going. So what I'd like to do is to unpack the logic that you've given us. And I heard Malcolm mention the word inflation, and I heard Winfred spoke about practical examples, your property prices rising. So let me start with a very simple question. And I'm going to ask you, Winfred, to answer this one. So what role does inflation play in your investment decisions?
Yeah, thanks, Errol. I'm going to keep it quite simple. I think for us, inflation, and put simply, it can reduce what is inflation. It reduces the value of investment returns. It's simple as that. So investors, when we build solutions, must therefore aim to increase what we would call their long-term purchasing power, and investment returns must in turn keep up with or outperform inflation in order to increase this real purchasing power. So at the end of the day, for me, Errol, it's quite simple. A good investment decision always factors in inflation and the impact thereof. And when you start ignoring that, then I would start questioning what really is driving the investment decision. That kind of gives
that makes a lot of sense. Now, Johan, you're a financial planner and you've been around for a couple of years. If I would ask you to answer that question from a financial planning perspective, how would you respond to that?
Errol, I think inflation is probably the most important key in our planning, because if your goal is to set out to say, listen, I'm going to go retire today with 30,000 rand a month in today's money, in 20 years' time, 30,000 is not going to be 30,000 rand anymore. The buying power of 30,000 rand is gone. So it's so important that we work out what is the inflation, what inflation factor, and to ensure that our investments grow more than inflation. And I think that the best point to illustrate inflation is basically post-retirement. Post-retirement, when you sit and do planning for a client, you say, okay, we're going to grow your investments are going to grow, and you take an income, and the income might grow by 6%, but your medical aid is growing by 10%. Your food is growing by much more. Your petrol is growing much more. So the gap that you have, disposable income that you're going to have in retirement is diminishing by the fact that if you don't bring into cognizance that inflation and what type of inflation you talk about post-retirement versus pre-retirement is totally different inflation rates. So it's crucial that we talk about inflation.
So perhaps from a financial planning perspective, it is kind of important to prioritize which goals you want to achieve. For instance, medical aid, and then attach inflation rate to that particular one. Is this what you're saying?
Yeah, correct. Because we need to make sure that we it's different goals that we want to achieve with different long-term investments that we need to make to get to those goals.
Okay. And I think maybe just to link it back to the previous slide and speak about inflation in general. I mean, over the last 15 years, inflation has been about 5.5% per annum. So if you want to keep up with that, you're going to have to invest in asset classes that can do that. Now, after tax, pre-tax, cash has done about 6.7. So it's beaten it, but you still got to pay the tax on the interest and the income and all the rest of it. Now, in a goals-based world, just linking it back to the diversification principle, where you're targeting at a portfolio of, let's say, inflation plus 5, you can't just sit in cash. Okay, you have to, you've got to take on some risk. You've got to invest in some of the higher returning growth assets, as I kind of mentioned earlier. I mean, in fact, over this 15-year period, equities is actually in South Africa done inflation plus 9, okay, and property inflation plus 11. So you could have got it, okay. Now, not to sort of guarantee that that's going to happen over the next 10 or 15 years, but it's really the theory of combining these different types of higher yielding asset classes or higher returning asset classes with cash to make a comfortable portfolio that achieves your specific objective.
Okay, Malcolm. Now, okay, you spoke about diversification. So let me ask you this question then. The inflation rate abroad is not the same than in South Africa. So what role do you think this would play when you talk about diversifying an investment portfolio, like locally and globally?
Correct. I mean, it plays a very important role. I mean, US inflation, as an example, is currently below 2%, relative to that South African inflation of about 4.5%. So in theory, the rand should therefore depreciate by 2.5% per annum. So having money offshore in dollars, would benefit South African investors in their local portfolio. Globally, inflation has been coming down, and this impacts the various asset classes differently. So lower inflation promotes lower interest rates, which promotes higher economic growth. And equities like high economic growth, while bonds like lower interest rates, and vice versa. Okay, it just really depends what the primary narrative is in the market at any point in time that determines whether equities beats bonds or cash. But more importantly, I think because the investable universe in South Africa is so small in the context of the world, diversifying your portfolio offshore can expose you to so many more opportunities, countries, investments, currencies, ideas, sectors, and stocks that investors can't necessarily get exposure to in South Africa. And it is this diversification that is probably more important than just investing offshore as a currency hedge.
Yeah, maybe, Johan, you will agree with me. If you look at, for instance, you have a goal, your child is going to study overseas. Wouldn't it make sense, and I'm asking the panel, wouldn't it make sense rather to bench your goal and your investment against the inflation of that currency, like in the UK or the USA?
Yeah, Errol, my whole thing in terms of planning when we sit down with clients is, if there's a goal, like you said, to go and study overseas, then abroad, or then you should invest in US dollars and maybe make sure that you get the growth in US dollars. But a lot of times we tend to measure our offshore investment in rand terms, and what clients really do, and it's so important that when we sit up with a client, we talk about inflation in the US and we talk about growth in the US, is not to convert it back to rand. We need to stick to that goal in dollars. And even if the dollar blows out, the rand-dollar exchange go to 15 rand, and you think, oh, I made a lot of money. You haven't made a lot of money.
Yeah, I think one should be mindful of the currency risk, because we're talking about behavior. So currency, it could be very much a greedy incentive and say, well, I'm going to bet against the currency, but is that sound financial planning? Let me move on to the next question, and I want to ask you this one, Winfred. I want to talk about time. You said time in the market, not timing the market. But now my question is, how long should it be invested for? Should it be 5 years? Should it be 10 years? And should it be 20 years? And then, so with other words, what is the relevance of term in the investment world?
Yeah, thanks, Errol. I mean, on the question of how long, Errol, I'd say that is unique to each investor, and more specifically to each goal that the investor is trying to achieve. So, and as much as we advocate long-term investing, as I've spoken about earlier on, in many instances, goals also have shorter time periods associated with them. So the relevance for me about term or investment time horizons becomes vital, firstly, when trying to manage expectations and predictability when it comes to investment outcomes. That's so important. Shorter time horizons also generally require more caution than do longer ones. But for me, the big takeaway in terms of the way I want to answer that question in terms of the relevance is it's so important to match or align your term with one's goals so that your investment strategy is aligned, and in doing so, you maximize your chance of actually achieving the success.
Okay, I want to talk about that a bit more, Johan, from a financial planning perspective. Let's stick with term. What does term mean? Where does it, or where is it that investment and financial planning comes together in respect of term?
Errol, I think it's like Winfred said, it's what's your specific goal. Whether it's retirement, I have a longer term goal. If I want to send my child to university in 1 year from now, it's a different goal, it's a different term, it's a different investment strategy that I need to take. But I think the most important thing is that there's a lot of element of greed. So if I go to a client and tell him, listen, this investment does 10% and this one does 5%, even if it's not the right investment, you'd rather go for the 10% and take more risk. And that's where my responsibility comes in. So listen, guys, there's a lot of risk in terms of this term. You got a short-term investment, we need to stick to short-term goals, even if it shows less growth in terms of your investment. But greed plays a very big role when people make investment decisions. And that's my role. How do I educate the clients? Listen, this is a long-term goal, we take long-term investment view. If it's a short-term goal, we take a bit more conservative view in terms of our investment.
So what you're saying that many people out there say, my goal is to make as much money as possible, and then I think about my goals. And you say it's actually the other way around. Let's think about your goals, put a term to it, and have some strategic planning. Okay, well, that makes a lot of sense. I want to ask, Malcolm, I want to ask you this one. You mentioned, you used the words correlation and diversification, as I said. Now, it seems that there's a strong correlation between term and diversification. Now, I know that diversification means more than just spreading your investments around. How would you respond to that?
Well, the principle of diversification is to spread things around, so it does mean that, but importantly to do it in a way that either promotes a higher return or gives you exposure to return sources that you previously didn't have. And I touched on this a little bit earlier. So let me then focus on term. Again, in theory, and in a traditional investment sense, with the asset classes that we have available to us that are listed and regulated, etc. If you have an infinite investment term, you would invest purely into equity and enjoy the compounding benefits that earnings growth has on share prices. As I showed earlier, they are typically the asset class that can produce the highest return. But for any realistic finite term, there's always the risk that at expiry, the market has just collapsed, wiping out your previous gains, and you then become you then are forced to sort of cash out your investments at lower levels. Okay, so to protect against this, including other assets in a portfolio that are uncorrelated to equity and therefore likely to be up when equity is down, is a wise investment strategy, and that really is the context of diversification. By definition, the shorter your time horizon, the less time you have to recover from a market correction, and hence the less equity and more cash you need in your portfolio. But now on the other extreme, if you want complete capital protection, then you would only invest in cash. Now you're just back into one asset class again, you've got no diversification, and you actually run the risk of underperforming inflation over the long term. So when it comes to term, medium to longer term investors need some form of asset class diversification to beat inflation and to provide some downside protection and a smoother ride relative to just being in equity. So that's the continuum that investors face.
Okay, so listening to Malcolm now, Winfred, let me ask you this. Now we've got this goals-based financial planning philosophy and investments. So how would we apply what Malcolm has said now in this goals-based financial planning and investment planning philosophy?
Yeah, thank you, Errol. I mean, I'm going to just refer to the investment philosophy or the financial planning philosophy rooted in goals-based as the same, interchangeably. So for me, that starts with the end goal in mind. And then from there, we build a financial plan to maximize our chances of actually achieving that goal. So to come back to, from an investment perspective, term and inflation, as we've spoken about, are vital factors to consider when one then decides on what's the appropriate solution. And this applies equally, locally or globally. I mean, Johan spoke about ensuring that you don't convert your offshore investment into rands when you're actually investing or saving towards that goal offshore. But then to ensure that the solution is not reliant on only one market outcome, we would want to ensure that we have a robust and a very well diversified investment solution. And that's the key here, to bring back the element of term and then diversification. I would then take this one step further and then saying, from an investment philosophy perspective, we would also want to talk about the fact that Malcolm has spoken about this, that we want to make sure our solution is tilted towards asset classes with higher future expected returns. That is what we've called growth asset classes. Because of course, we want to make sure this is done within set and appropriate risk constraints.
Okay, well, thanks, Winfred. So I've heard now about term, I've heard about inflation, and I've also heard about diversification. So, Johan, tell me, do we have tailor-made funds? Tell us more about the tailor-made funds that one can use in these type of scenarios that we sketched now.
Just from my side, it's I think my role as a financial planner is to determine what the goals are and what do we need to get to attain that goal, inflation plus X or Y or Z. I am not an asset allocator. I'm not an asset manager. And that's where we rely on Malcolm and Winfred and then to provide us the solutions to be able to achieve those goals. So my role is to determine the goal, to see how much and what investment strategy we need to follow, and then to monitor on a regular basis to see if we're achieving the goal and if we need to change our tact with what we do to get to that specific goal. So and that's where we have the tailored solutions. We've got our goal-based, our standard funds and everything like that, what we can utilize. And I love that type of philosophy because, like I said, I am not an asset manager. I don't want to select funds. I don't want to blend funds. I rather want to use a bespoke solution.
Yes, and I want to talk later on. I want to discuss the point, the value of a financial planner. You touched on a very important point. But let me get to I think the second last question. And okay, so we've heard all these things, but now I want to know from the panel, why is it that people do not stay the term or on course? And what is the relevance of that to the quote of Warren Buffett? The most important quality for the investor is temperament and not intellect. And let us start with Malcolm. What do you say?
Well, the most common reason is obviously that their needs change, or potentially when they thought that they were actually aggressive investors, they actually turned out to be conservative investors. And I mean, it is a problem in the industry. The reality is that if you've correctly identified your goal, as you said, and you're prepared to stick with it, you're prepared to be disciplined, okay, the market should generally provide you with whatever the outcome is that you're looking for in a realistic time frame.
I don't know, Johan, do you have any comments on that? What's your experience on that?
I think, to me, the most important thing is regular communication with my clients. We need to sit down and on a regular basis listen, this is the goal that we want to achieve. We have bad times, we have good times. When there's bad times, we need to say, listen, guys, we're having a bad time, but let's just stick it out. Let's ride it. This is our goals. This is what we determined. And my role as financial planner is to help the client hold his hand through this process and to make sure that we get to the end goal and not just forget about him. I think that's the most important thing. Even communicating when the funds are not doing well and the markets are doing well, keep on communicating, keep on with the clients and keep on holding their hands and keep on guiding them to make sure we get the goal.
And coaching them about that volatility.
I was going to say that educating is still a key word to me. What did you want to mention?
Yeah, that's what I was going to say. I mean, Errol, I think people are emotional beings, and investing can play havoc with one's emotion, especially if there's no well-devised plan and no coaching in place to that's been crafted up front to guide you. So this is particularly true when we have markets as we currently have, one day up, one day down. What do you do? So I always say, to me, the best defense is, as you've said, Errol, is to educate oneself. Understand the asset classes, as we've spoken about them. Understand you invested in them, how they behave, and what they expected to behave in certain conditions. Understand the lessons of the past. Yes, past performance does not guarantee future returns, but let's understand and what we can learn from the past. And also, however hard it may be, a well thought through plan, one that's crafted at the onset, whether you do it on your own, whether you do it with professional advice given to you by a qualified person, as we have here at SPFC. It's not always easy, but that's always the best answer, is to stick to that. As I said earlier, sometimes the best answer is to do nothing, is to just ride it through and stick to your plan. And of course, to tie this back to Warren Buffett, it's to have the temperament to do that, is to stick to what you set out to achieve.
Well, let's end off with some final thoughts and to the panel with the last question. So this goals-based financial planning, we spoke about process right from the beginning, Johan. So how can this process help us to overcome these emotions and to provide a logical solution? I think we've covered most of it, but any final thoughts on that?
Errol, I just think the most important thing is, that we need to define our goals. We need to know where we're going to, and we need to say, how do we regularly communicate? How do we check? How do we measure? How are we going to it? And to be there, I need to understand. In May we had a bad month, but I need to understand as a planner why we had a bad month. Because when I send out my statements every month, the client will phone me and say, why did we have? What do we need to do? And I need to also understand what it is, and to give them some guidance and to give them some comfort that is just a short term or whatever it is. So I also, as a planner, need to be up to date in terms of what's happening. So I can also walk the walk with my clients in terms of what we need to do.
Okay, well, some valuable input here. So let me try and then summarize. And first of all, thank you to our panelists. What I've heard is the following, is that is that certain aspects is important and a person needs to be educated. Now, I've done a little bit of looked at global research, and global research has shown us some very interesting investment results when it comes to the behavior of investments and in times of uncertainty. Now, often the outcomes, as Johanna said, is linked to the value of advice, and specifically the role of a financial advisor when giving advice. So many investors think that the value of an advisor, as demonstrated by Johanna, is selecting the correct funds and thus to increase the investment returns. Research has shown quite the opposite. Firstly, as shown by Malcolm Winford and Johan, asset allocation for a specific term, coupled with an inflation-beating strategy, is key to proper investment and financial planning. Now, research has shown that many investors value the advice of financial planners that can explain these financial concepts, the education, well in a simplified manner. Furthermore, combining these investment fundamentals to formulate a financial planning strategy is key to investors. Remarkably interesting is that most investors think that being educated to manage their behavioral biases, such as greed and fear, are not important. No surprise then that Warren Buffett said the most important quality for investors is temperament, not intellect. Now, let me move on to some other research, and this research was done in 2019. Vanguard research conducted in 2019 has shown that the behavioral coaching may add a 1 to 2% net return in your investment. Quote, the rationale is that because investing evokes emotion, advisors need to help their clients maintain a long-term perspective and a disciplined approach, unquote, says the report. It further concludes that, quote, advisors can act as emotional circuit breakers by circumventing clients' tendencies to chase returns or run for cover in emotionally charged markets, unquote. Now, research done in 2019 by Morningstar comes to a very similar conclusion. It states that behavioral coaching is the single most impactful thing an advisor can do, adding on average 150 basis points. As investors, emotions can be our own worst enemy, especially when the markets are volatile, and guidance from a behavioral coach can save us from panic selling and abandoning long-term financial plans, unquote. The research has shown that there are some aspects where advisors and investors are on the same page and have similar outcomes, namely, and Johanna said it, communicate and explain financial concepts well, term and inflation, and then help the investor reach his or her financial goals. Now, not surprisingly, where the research compared what investors value and what advisors think investors value, the largest gaps were. The advisor must maximize the returns for the investor, which we know now is no longer true. And the other one, help me stay in control of my emotions. And here's the proof. Investors places this feature last on their list. And this is not all. Here comes the shocking surprise. Many advisors think that this feature also should be low on the list of priorities. So, to end off, the complete answer is then amazingly simple. And I will try and formulate. The financial planning process should incorporate meaningful education on simple financial concepts, such as asset allocation for a specific term, linked to your lifetime goal, and must have an investment strategy to beat inflation. Once these concepts are properly understood, will it be a lot easier to have a conversation about emotional bias and how to ensure that logic overrides emotion. And that is what I think Warren Buffett meant by the most important quality for investors, temperament, not intellect. Now, the quality he spoke about can only make sense when an investor is able to make an informed decision. And this is the function of the professional financial advisor. Well, I thank you to my panelists, and let us see if you have any questions for us. If you can just help us with.
Okay. Let's see if any questions have popped up. Okay. There you go. There's one from Jesse. How does overconfidence as a behavior bias affect an investor's decision over time? Is high trading frequency really bad? That's from Jesse Kiheka.
Well, let me just touch on high trading frequency. I mean, obviously, if you have a day job and you've got family and it's not really your sort of focus area, then it's probably a very risky thing to do. But if you're a dealer or a trader on the market, then yeah, absolutely. Maybe you could do quite well, but it is understanding the market and the game that you're playing at the time.
Malcolm, I also think, even if you look at someone that's from a Melville Douglas team or stockbroking side or whatever, that does that for a living and does every day, they also try to stick not to too much, fundamentals doesn't change overnight.
Sure.
So the balance sheet of the company doesn't change overnight. So it's also, they will try to pick a stock and stick with the stock for a period of time, rather than trading too much.
Yeah, it's a good point. I mean, the typical holding period for managers that we select in the equity space, as an example, is 3 to 4 years.
Yeah. Sorry.
Maybe just the last point from our side is on the overconfidence side, to answer that question, is also to have an exit strategy at some point. To understand that that this is an exit target that I have, and at that point I'm happy to exit my position and not to succumb to greed.
And here's actually a very good question, Rainier. You said, can you please define short, medium, and long term? Now let that be a lesson for us, because we assume that people know. So how would we respond to that one?
Look, there are some industry guidelines, but it's very rule of thumb. So short term is 0 to 1 year. Medium term is sort of, maybe 1 to 5 years. And then long term is longer than 5. But the reality is that when we think long term as investors, we think in 10 years plus.
Yeah, so maybe 3, 5, and 10, those numbers that I earlier perhaps. Okay, let me see, here's another one. Could you briefly expand on understanding individual appetite for risk? That is a loaded question. When you look at the risk, you can look at it from and I'm not going to make it short. You can look at it from an investment point of view, and you can also look at it from a financial point of view. So really what you have to do is you look at the risk profile of a person. And the risk profile is exactly what it says, the risk that you encounter in life. The risk of not having enough funds, the risk of even losing your life. All of those things are material. And when you look at profile, you think like Facebook. Profile, who are you? Winfred mentioned that you are unique. So when we look at the risk profile, to answer it shortly, what we'll be looking at is to see what is the risk required. And that speaks to the inflation and the term. You also look at the risk capacity. With other words, whether you can afford to perhaps if you lose your job, to continue with the investment. That's the capacity you've got the monies available. And then the least important to me when it comes to the risk profiling, but is the one that we spoke about today, is that tolerance. With other words, that goes down to, and then that is a subjective factor. The others two are very objective. But I can show you all the logic that well, let me give you an example. A person goes on a retirement. So when he goes on the retirement, what kind of strategy are you going to choose? Are you going to choose a very conservative one, or are you going to choose one with growth assets? Because the term, once again, could be 20 years, 25 years, depending if you provide it to your spouse. So logic dictates that you should have growth assets. But you have that discussion with a client when he can see that his monies, let's say he's got 10 million, 15 million in a pension fund, and every year going into the consumption phase, he can see actually his money dwindling away, but he's losing the opportunity cost. So what does this person say? I can't stand it. I simply want to go into a more conservative portfolio. But then you must understand that you lose the opportunity to catch up over the long term. And that's what I mean by an informed decision.
So Errol, just quickly, I did a review yesterday with one of my very wealthy clients, and he's in a conservative investment, and it's a long-term investment. But he said, Johan, I can't stomach he understands that it needs to be a long-term investment. He understands that we need to do, but he doesn't want to take a risk. He's got enough money, and he said, listen, I can't stomach losses. So, or negatives or anything like that. And he will stay in that conservative, even if it's a long-term investment. His appetite for risk is very, very small.
Yes. Okay, here's the last question then, which I can ask the panel. How can you better an investment portfolio by including a foreign asset class while considering matching with foreign inflation? I think actually what it says, if you've got a local fund, why would you have a foreign element? And then obviously when you go directly offshore, it would be foreign. It's two different discussions, I would tend to think. I don't know, Malcolm, help me out here.
Look, I think it's becoming very popular in the industry to create solutions for clients wrapped in collective investment schemes, as an example, that are multiple assets or multi-asset. And in having multi-asset portfolios, the principle of diversification applies, and hence you have some local assets, some global assets. Now, current regulation allows you to have up to 30% in global assets, in other words, assets outside of South Africa, plus another 10% in Africa. And that hasn't been sort of utilized that much, but certainly we see a lot of asset managers with 30% global equity in their portfolios, or at least 30% offshore exposure in their portfolios. And really, it benefits from the two things. If the rand appreciates, that's good for you as a local investor, okay? And obviously, if those offshore assets in dollars go up, that's good for you as a local investor. So it's kind of sort of fit in the one-size-fits-all principle. And typically, there are, let's call them, low equity multi-asset funds, medium equity multi-asset funds, and then high equity multi-asset funds. Those are the ones that can't have more than 75% in total equity as a whole. And those are three very simple profiles for investors to choose from based on their particular needs and circumstances. So, yeah, you do get exposure to the various opportunities in countries and currencies and ideas and stocks that you wouldn't necessarily in South Africa by going offshore. And yeah, you are exposed to offshore inflation as opposed to South African inflation.
Well, thank you for that. Our time is up. I see it's 2 o'clock. So thank you very much for the panelists for joining us and for the discussion.
Thanks.
Thank you, gents. That was very informative. There was a lot of information unpacked in that hour. I think for some of the audience, there might be some things you want to hear again. So we are recording this session. It will be posted on the Standard Bank YouTube channel, so that if you want to go back and revise what the gentleman said, you can do that. For our internal staff as well, it's on our SharePoint portal to be posted by tomorrow, so you can get that information. And for some of the clients sitting out there who don't have a financial planner, you can walk into any Standard Bank branch and ask to see a financial planner there, and you'll get one. If not, if that's too much hassle for you to do, you can SMS the word guide to 31791. If you SMS that word, a financial planner will be in touch with you and try and get in touch with you. Or if you prefer email, you can send an email to SBFC Voice and Digital at standardbank.co.za. That's SBFC Voice and Digital at standardbank.co.za, and just request a financial advisor to contact you. That will also happen. Thank you very much, ladies and gentlemen. I hope that was informative for you. I feel if I had the 4 of you guys put in one as my plan, I'd be very far in life. So yeah, I'm going to be re-listening to this one. Thank you guys. Have a good afternoon. Have a productive day, and we'll see you on our next webinar.